Good evening and welcome to Moneyfarm Open. We will wait a couple of seconds just to allow some people to join, but thank you for joining us this evening. Just to give you a bit of flavour of what it's about, we are running a series of events through to the end of the year, the first of which obviously is tonight. The next one will be in November on pensions, and then we'll cover a variety of topics as we get closer to the end of the year. This evening, obviously, given the nature of the year so far, we thought that we'd start with markets and investments. And as a result, I'm joined today with our Chief Investment Officer, Richard Flax, and he will run through some points about where we are, and we'll obviously have a Q&A, but we'll touch on the agenda next. Just a note, we are recording this, so if you need to leave or if you miss something or anything along those lines, do not worry, we'll send out a recording afterwards and you'll be able to catch up from there. Also, if there's anything that you particularly want to touch on one-on-one, we really encourage people to book appointments and you can have a discussion with their consultant after this later in the week or next week as well. I think, should we get started? If we move to the agenda slide. So this is ultimately going to be a Q&A where it allows you, our investors, to ask some questions to Richard and some to myself where I can. And we will touch on things that we get during the events, and we will also touch on questions that people have very kindly given to us beforehand. On top of that, Richard has prepared a few slides giving a bit of an idea of where we are. So we'll start with that, just an idea of where we are in the markets, what we're thinking, where we're looking. Obviously, in light of recent events, a little bit of a conversation about the UK. I will touch on a couple of points about kind of behaviours, thoughts, context, etc. And then we'll get into the real nitty-gritty of the Q&A. There is a Q&A section at the bottom, so please answer any questions that you have. They can be anonymous. We have a team of people, so consultants and portfolio managers, who are answering the questions live, and obviously we'll try and capture as many as we can here and have a discussion about them and go from there. So yeah, without further ado, Richard, over to you.
Thank you, Chris. Thank you everyone for joining this evening. So I'm going to do a few things. I'll talk a little bit about where we are, where we've come from, talk about some of the drivers that we see in markets at the moment. And I guess when we started to put this presentation together, the UK was probably going to be less of a topic than it will be this evening, but obviously given events of the last few days, we thought it was appropriate to talk a little bit more about the UK than we might previously have done. With that in mind, so let's just start with where we've come from. And this chart really shows the performance of a range of ETFs covering global equities and UK bonds over the course of the year. And what you see is that first and foremost, it's been a difficult year in markets, as I'm sure most of you know, but the real pain has actually come in the bond market rather than in the equity market. And the more longer dated bonds that you've held, the more challenging it's been. And that's particularly true for UK bonds. So the bottom two lines here are two long dated UK bond ETF, one for inflation linked bonds, one for nominal bonds. And the lines above are, broadly speaking, global equity ETFs and one short-dated UK government bond ETF. And it really gives you a flavour that for all of the focus on the equity market, it's really been in the bond market that the biggest, some of the biggest losses that we've seen over the course of the year. Where have we come from? Well, first and foremost, we start with inflation. As all of you know, inflation is running well ahead of where it's been over the last 20 years and well ahead of central bank targets. So you see in this particular chart, you've got the 12-month inflation for the US, for the UK and the Eurozone, all of which are at or very close to double-digit inflation compared to a central bank target of around 2%. I would highlight here that just at the end, in the case of the US, you've seen a step down in that number. And maybe that gives us some sense that inflation in the US may have begun to peak. That's something that we'll dig into in a little bit more detail momentarily. But really from the start here, it's high inflation has been a key driver for some of the moves that we've seen in financial markets. With that in mind, central banks obviously have a mandate to keep what is called price stability, or around 2% inflation. And so you've seen central banks begin to raise interest rates. Here's the same three central banks and their policy rates. And after an extended period of very low interest rates, you see that they've really begun to tighten policy in earnest. And you could say that they're behind the curve. Obviously, inflation is already close to double digits. But it's something that we've seen over the last few months and something that we expect to see more of in the coming quarters. Those high policy rates have translated into higher government bond yields, and that's been behind some of the losses we've seen in government bonds over the course of this year. And as you see here, it's really coming at the end of a 30 or 40-year period of steadily declining government bond yields, from the late 80s and early 90s on to where we've been really at very, very low levels in 2021. That means going forward, you may be able to see better returns out of government bonds than you have done over the last year or two, certainly in terms of their yields. But the question that we have to wrestle with is really at what level do we think is a neutral bond, a neutral policy rate, and by extension, where do we think government bonds will really begin to stabilize from a yield perspective? Let's go back to inflation for 1 second. And so there are some reasons to think that perhaps inflation will begin to turn, particularly perhaps in the US. Here in this particular slide on the left-hand side, you see an index of container freight costs. And if you remember, in the wake of the pandemic, it was very difficult and very expensive to ship containers around the world. There was a shortage of supply. Supply chains were and still are in some cases challenged. But what we do see is that container rates have begun to come down from the very, very high levels that we saw in 2021 and in the early part of this year. And that's something that we would expect to see continue. On the right-hand side, and this comes to a question we often get about commodities, in the wake of the invasion of Ukraine, we saw a spike in commodity prices, but actually really since the middle of the year, we've begun to see commodity prices come down. That's particularly true for the oil price, which is the top line, but we've seen it in a range of industrial commodities and even in some agricultural prices as well. And that's obviously a crucial component, particularly in emerging markets where food is a very large percentage of the basket. So from the perspective of the supply side, we do see some signs of improvement in terms of pricing, and we think and we hope that that will begin to be reflected in lower inflation in the coming months and quarters. On the other side, on the demand side, I've taken some charts from the UK here. Then this is very interesting. So on the left-hand side, you see the unemployment rate. And the UK unemployment rate is still very, very low versus history. If you're looking for a job, generally speaking, you're able to find one. But on the right-hand side, what you see is that UK consumer confidence is as low as it's ever been. And to a large extent, that's a function of the very high cost of living, as we know. But when we think about the mandate for central banks are looking at that unemployment rate and possibly thinking that they really need to see that unfortunately begin to rise so that they can see that demand in the economy begin to weaken a bit. And that's the way that they can begin to bring down inflation. Remember that central banks can do relatively little to affect the supply side of an economy. They're much more effective at dampening demand, and that's probably what we're going to see. So now let's turn a little bit to other markets, and we'll turn to equities. And the key point here, so these charts are valuations over time. On the left-hand side for US equities, on the right-hand side for non-US equities. And what we see is that after a very sharp re-rating during the course of the pandemic, equity valuations in the developed world, at least, are in line or below their long-term averages. Now, that's not the same as saying that we're going to see a very strong short-term performance, but it does suggest that when you think about the long term, starting valuations are significant. And so from this perspective, it gives us some comfort that if you look out over a strategic time horizon, you're at a better entry point than you have had for some time. And just to take it further, on the left-hand side, you see the UK, and on the right-hand side, you see emerging markets, and it's a similar picture. The UK looking particularly, these are UK large cap stocks, looking particularly attractively valued relative to its history. Now, there are some challenges around that. But again, the key point is that from a long-term perspective, with starting valuations as really a key driver, equity markets look a bit better than they have done in the past. The second component here is really about earnings expectations, the denominator in that price-earnings ratio. And so on the left-hand side, you see earnings revisions. That's the expectations of what corporates will earn in a particular year and how those expectations have changed. And you see here some interesting things. The first part is that the bottom line is emerging markets. And so you've seen steady downgrades in emerging market equities. Some of that, we think, driven by a relatively slow recovery in China. The middle two lines are the US and the Eurozone. And actually, despite all of the negative news on the economy, earnings for these companies have actually held up relatively well. Analysts haven't been forced to downgrade those estimates by a huge amount. They've done it a little bit, but not dramatically so. And then on the top line is UK equities, where you've seen steady upgrades, partly as a function of stronger commodity prices earlier in the year, and partly because the UK large cap index has a lot of its earnings outside the UK, and so is actually a beneficiary of a weaker sterling. And the right-hand chart shows profit margins for assortment of global companies. And there are a couple of interesting things to look at here. The first is that overall profit margins have drifted higher over time. From the start of the period in the late 80s and early 90s to where we are today, seen a significant improvement in corporate profitability. The second part is that corporate profits, as you might expect, are cyclical. When the economy is relatively weak, corporates earn less money. And so you see that in the early 2000s, after 2008, and during the pandemic, you've seen these drops in corporate profits. And one of the key things that we discuss is really what's going to happen now. As you can see, corporate profitability has dropped a little bit from the peak, but still looks pretty strong versus history. And so one of the key questions is to what extent corporates will be able to manage their way through the current challenges while keeping their profitability intact, or will we see margins come down as we have done in previous periods? And our thinking currently is that we will see margins come under pressure, at least a little bit, not as strong as has been the case in other more significant recessions. But some of that we think is already factored in by the lower valuations that I referred to earlier on. Now let's talk a little bit about the UK. And a couple of charts for context. The right-hand chart shows the UK yield curve, so UK government bond rates at various points. The bottom line is a year ago, the next line is 3 months ago, next line is a week ago, and latest was yesterday. And what you see is this meaningful shift up in the curve from 1% approximately a year ago to around 4% today. And that's very profound, and it speaks to, first and foremost, changes in inflation, as we mentioned before, and changes in expectations for the Bank of England, but also more recently, some of the volatility that we've seen around the latest government announcement. And the left-hand side chart captures that. It shows the daily movement in the bond yield of the cost of borrowing for the UK over 2 years. And so on Friday, which is the last date here, you saw the biggest increase in the last 30 years for UK 2-year government bond yields. And it speaks to some of the concern about what the government has announced. And the fear here is that the government has announced effectively some additional government borrowing. You're going to cut taxes. You're not going to cut spending on the other side. In fact, you're going to increase spending at a time at which inflation is relatively high. And you're going to go to the bond market and effectively borrow this money. At least that's our interpretation. And the bond market has collectively said, well, if you want to borrow more money from us, then you have to pay more. And so that's, to some extent, is what we see. And the other message that we think is being sent is that collectively investors don't really think this is a good idea. And so there's a tension here between the bond market, between the government, but also with the Bank of England, where the Bank of England seems to say, well, if you're going to increase spending, we're going to have to increase interest rates perhaps more aggressively than we thought we would otherwise have to. So you have the government on one side trying to accelerate growth through fiscal spending, and the Bank of England effectively trying to slow growth down through tighter monetary policy. And this tension is one of the things we think that is causing some challenges in the UK financial markets over the last few days. I guess we'll talk more about that in the Q&A. So let me just put some concluding thoughts. First and foremost, it's been a challenging year, but particularly in the bond market. It's fair to say valuations have improved, we think, and we think that that's an important driver for long-term returns. It's very interesting to us that earnings and profitability have held up relatively well so far. We think that we will see some downgrades to earnings expectations, but we think that a good amount of that has already been priced in by financial markets. It seems to us that the global economy is beginning to feel the impact of higher interest rates. We are beginning to see a slowdown. And we think that in the US particularly, we may see signs of inflation beginning to slow. Perhaps not as fast as markets had previously anticipated, but moving in the right direction. We think that that's an important consideration when you think about the need to bring supply and demand back into equilibrium. We think, as we mentioned briefly, that the UK policy mix looks particularly difficult at the moment, and it'll be interesting to see how the different authorities manage this. And in terms of the key considerations, the things that we're thinking about, how quickly will inflation fall? We think that we could see a divergence between the US and Europe and the UK, to some extent driven by some of the energy challenges that the Eurozone is facing. We think that economies will slow down, and we wouldn't be surprised to see negative growth for a period of time. We think that this will have an impact on profitability, but in general, we've been comforted so far by the way in which corporates have been able to hold their profitability, even if we do see some risk to the downside over the coming quarter. So from a long-term perspective, we see better valuations. We think that there will be some short-term challenges, both on the macro side and in terms of corporate profitability. But we think that a good amount of that has already been factored into markets when we think about particularly on the equity valuations. So that's the brief introduction. Let me stop there and turn it over to Chris.
Thank you, Richard. Yes, very, very interesting. Thank you, guys, for those who have asked questions so far. Very good ones. We will get to them. I think there's a few. Definitely very, very good ones there. Please keep them coming. Any questions that we do have, we'll try and address later on. So yeah, for the next points, just a couple of points. I mean, it wouldn't be a markets commentary without the advisory side. Just wanted to run a little bit of context, a bit of behavior activity on it, but it's just a couple of points really to add. So I'm sure a lot of you have seen charts like this one a lot recently, and it's just about providing a little bit of, yeah, like I said before, context and a big picture view. Obviously, Rich and his team are very busy navigating current waters, but the question always comes to us on the consultancy side, on the client-facing side: well, what should I do? What's my activity? And ultimately, what I want to show here is ultimately, for the long-term investor, time is your best friend. What this chart actually shows is basically, it was done at the start of the year for our strategic asset allocation event. For those that caught it there, you're probably seeing it again, so apologies. But basically, it's the returns of the MSCI World, which is the global index, from 1970 to the start of this year. And what our team have done is calculated over various periods through time, what is the probability that you'll come out with a loss on one side versus the time that you're looking to invest on the other. And the point here, basically, the blue part is the actual kind of the averages, and the black line is a simulated kind of, let's say, trend line. But the key point here is that ultimately, the longer that you can invest for, the better outcome, historically, at least, you would tend to have had investing, particularly or exclusively here in equity markets. And this feeds into how we calculate the suitability for our portfolios. So for those of you aware, obviously, the time frame that you put in will impact the level of risk that we give you, based predominantly on this kind of mindset. So if you have a longer time frame to invest, we tend to allow kind of markets to cycle, to go up and down and through, and this will benefit people in the long run. If you wouldn't mind skipping to the next slide. So a lot of people say to me, yeah, well, now's different. And I've shamelessly stolen this chart from a chart book from Morgan Stanley back in 2018, and I still wheel it out all the time because it's very, very good. Ultimately, the point that this is trying to show, so obviously, people aren't going to be investing for that full period of time, but every time it always feels like this is a really, really bad situation. And through time, there have always been really, really bad situations. However, the long-term investor has always been rewarded for their patience, has been rewarded for their time, they're kind of allowing markets to go through their cycles. And, obviously when markets are falling, obviously it can be very uncomfortable. And if you are uncomfortable, please reach out to us and speak to your consultant, because obviously this is what we are here to do, and we're here to make sure that everything is manageable. However, for those that are comfortable with it, the idea being is obviously if you do hold on, you are rewarded through time, even if this particular scenario feels like a particularly extraordinary period. This is not the first extraordinary period we've had in history. So that's the key point there. Just final slide, really, just bring it back home. But one of the points about being a fast-growing business is a lot of our clients join us more recently, and we get a steadily growing group of clients who are kind of 1 year, maybe you joined us from Wealthsimple, and obviously the experience that you've had on your portfolios has been more negative. The key point I wanted to show here is ultimately, cumulatively, despite the negative periods that we've had, again, showing the point of long-term helps to benefit portfolios. Since our inception, we are still nicely positive. We're happy with where we are, despite the sell-offs that we've had. And I think this is really key to stress. And again, it's all about giving perspective and allowing you to really kind of understand, okay, this is a snapshot. Obviously each day you might see portfolios go up and down, and obviously in this period more down. But obviously from a bigger picture perspective, we've seen this before. And hopefully we will see the continued trend that's always been through history. So on that note, thank you everybody for those questions. I think if you stop sharing, it will bring to us, and then obviously we will touch onto the Q&A. So again, we'll continue to pick ones up as they come through. However, I will start with some that we've had before, and obviously continue some of the questions that we've had. So Richard, one that we got earlier in the week. How will a potential effect of recession in the UK affect portfolios?
Sure. So a couple of points worth making about this. First and foremost, I think that the portfolios are constructed globally diversified. You've heard it before, I'll say it again. And so a recession in the UK in and of itself will have an impact, but perhaps will be mitigated to some extent by some of our global exposure. But it's also fair to say that we will see at the very least a slowdown globally. So the question is what impact will that have? We think that in general terms, a meaningful slowdown in growth, as we may see, can hit corporate profitability, can hit earnings, will hit households. There's likely to be less spending around for a period of time, and so that historically has impacted financial assets like equities that have that are more growth focused. Let's put it that way. The challenge here is as I said before, really on the inflation side. You want to see inflation come down, because one of the things that you will have noticed over the course of the year is that the sort of traditional arguments around diversification have been less effective, because bonds and equities have both suffered in an environment where inflation is relatively high, and where growth is beginning to weaken. So the other component to consider is that markets are somehow forward-looking, right? They don't think about what's going to happen today. They look out some undefined period into the future. So where are we today? Well, we think that the global economy is slowing, and may and some parts of it are likely to fall into recession. We think that some part of that is already factored in by financial markets, and you can debate sort of endlessly how much and to what extent, and some of it depends on how deep a recession we have. Do you if you have a sort of a slowdown, then you might say, well, a good amount of majority of that might already be priced in. If you saw a deeper recession, you might say, well, it's going to be, it's not priced into quite the same extent. But the key point here is that to some extent that markets are factoring in a meaningful slowdown in growth, whether it's negative, whether it's zero, it matters perhaps a little bit less. So it will have an impact on portfolios. We would argue it already has had an impact on portfolios. And so the key area of focus is really to think about not whether it will, how much worse it will get from here, but really to think about the environment in which we're going to find ourselves. How quickly will inflation come down? When will central banks be able to finish their tightening cycle? And how well will corporates, broadly speaking, be able to weather this? Because we don't think we're at the end of it, but we do think that we're some way through it, and that's already been reflected in financial asset prices.
Fantastic. And that actually leads us to a couple of questions that could be very good tangents. I'll start with one that we received actually earlier in the event. Actually, but from the first slide itself, what's driving poor performance in bonds?
So I think that the first point is starting valuation. So we all talk about high equity valuations, but if you think of a bond yield as a bond valuation, then you had very, very low bond yields. And you had low bond yields, one, because inflation was relatively low for an extended period of time, because central banks were buying up a lot of government bonds in a form of quantitative, what is called quantitative easing. And as inflation has now risen, some of that stimulus is being withdrawn. And so the starting valuation of bonds has been high versus history. The second part of it is, as we mentioned before, is really around the inflation and inflation expectations. And it's fair to say that if you went back a year and you looked at what financial economists were forecasting for inflation, very few people were forecasting inflation in the double digits. Some of that is a function of post-COVID stimulus. Some of it is we would argue a function of commodity prices in the wake of Ukraine. Some of it is the supply chain issues that we've alluded to. Those are the short-term questions. And then there are the longer-term questions, which is around things like demographics, around security of supply, something that was very much brought home during the COVID period. And so will we see businesses try and shorten their supply chains, perhaps at the expense of having higher costs, because they feel that they need to have that security of supply. So there are some long-term issues here as well. Demographics, for instance, another one that often comes up. But that's starting expectations and the extent to which inflation has surprised on the upside has also been a significant driver. So to me, it's really those two things: the starting valuation and the inflation surprise, and then the policy response that has come from it.
Fantastic, thank you. And that dovetails actually into a question that we had earlier in the week for someone in, and it's a question we get quite often from our clients actually, in terms of within the portfolio, given the environment that we're in, what place do bonds still hold in a diversified portfolio, particularly in an environment where you said obviously correlations themselves are obviously positive, whereas previously they were a way of diversifying the portfolio.
So I think, and you see this, the question gets framed in a number of different ways. One way is to say, well, there was the 60-40 portfolio, 60% equities, 40% government bonds, and is that now kind of dead? And so there are a couple of points worth making. Generally speaking, in the past, you would have held bonds and you would have earned a return on that, as well as having a diversification benefit. And with bond yields so low, and a yield curve so flat, right? So going out to buying longer dated bonds didn't really get you much more of a return. You were really thinking more about diversification than actually earning a return from it. And the problem that you had is actually on some level, having bonds in the portfolio has dampened the volatility even this year. Just hasn't really helped from a returns perspective, and that's been more challenging. But there were ways to mitigate that, and you saw it in the first slide, which was that if you didn't buy a lot of long dated bonds, if you mostly held short dated bonds, then some of that was mitigated. The other part is that if you didn't own, if you only thought in terms of long dated government bonds, then you closed your the opportunity set down. So you didn't have high yield, you didn't have emerging market debt. And actually, if you look, emerging market debt at the long dated emerging market debt has struggled, but actually some of the short dated emerging market debt, particularly short dated dollar emerging market debt, has not done too bad. And has actually, ironically, in the last week or so, helped in the context of weaker sterling. So that's the past. So you did have challenges. The ability to earn a return from long-dated government bonds was not there. It clearly, if you were held a lot of those, then you've suffered and you've taken on a good amount of duration risk. But you didn't have to. You could buy the shorter dated, and you could go elsewhere in the bond market and try and eke out a return. Now, going forward, obviously, as you saw in the case of the UK, you've got bond yields now up at 4%. Even with a challenging environment, the ability to earn at least a nominal return, maybe not necessarily a real return, a nominal return is much better than it was. So, what you have seen painfully is that the case for those longer dated bonds is better than it was. And as a team, we continue to debate it all year, whether we should lengthen the duration to buy more of these long dated government bonds. We so far have not really done it. And our duration is still relatively low, but the case is better than it was, particularly if you begin to see signs that inflation is peaking. But it's an important question. It's an important question that we continue to wrestle with, and what has become clear this year, particularly with very long duration government bonds, is that you can suffer for them.
Yeah, excellent, and that part about the UK brings us to a very eagle-eyed client has asked a question during this and asked about the rebalance that we did yesterday. And by selling sterling hedged elements from the portfolio in the rebalancing, are you predicting sterling falling further?
Yeah, so it's a very interesting question. Sterling has been one of the source of much debate and painful debate over the last few months. So there's a couple of answers, right? The first answer is that we think we were, I think it's fair to say, planning to to reduce some of our sterling exposure in any event. But we do think, as I alluded to in the presentation, that the current policy mix in the UK is challenged. And so if you think about it from a risk perspective, there, it seemed appropriate to us to manage some of that currency risk. We still have a good amount of sterling in portfolio, so it's not as if we've sold it out completely by any means. We have it either through some bonds, we still have some sterling hedge instruments, but we have reduced that. And with hindsight, we would have inevitably done it sooner. But I think that the range of outcomes for UK assets has probably widened over the last few days, and it seemed prudent to us to go ahead with the rebalance as it was originally set up, even though we've obviously seen a good amount of volatility, because that range of outcomes is wider than it was, and so that from my perspective at least seems like prudent risk management, inevitably sometimes painful prudent risk management. But that seemed, but we thought that was the appropriate thing to do in the context, I should say, also of our starting position, which I would say had a good amount of sterling still in the portfolio. It was a bit kind of 50-50 approximately.
Sure, that brings us to a very similar question that's literally just come through off the back of that, and it might be quite nice. So we're explaining it within each portfolio. Obviously, we have the different risk levels, different levels of currency hedging. What's our kind of policy on that? Do we have a thought process? Yeah,
sure. So look, generally speaking, the rule of thumb, which is the starting point, is generally that we will hedge most of our fixed income exposure and hedge rather less of our equity exposure. Let's put it that way, and say that the logic being that theory being that the currency might explain more of the total return from fixed income over an extended period of time relative to equities. We had probably a bit more hedged equity exposure than with hindsight we probably should have done. And we also had a number of fixed income instruments that weren't hedged that we chose not to hedge. So it really does vary by individual situation. But if you wanted to think about it as a starting rule of thumb, you would say that the starting point would be to hedge the fixed income exposure and not to hedge the equity exposure.
I think it's also worth noting, actually, for the risk level of the portfolios, obviously we manage portfolios to volatility target. Currency itself introduces a large amount of volatility into portfolios, particularly as we've seen over the last few days across the news. So those of you who have a low risk portfolio, what you'll tend to find is you will have a high number of hedged ETFs, just purely because actually that's not necessarily a view on the currency per se. It's actually managing the volatility of the portfolio. Whereas in the high risk portfolios, that gives a little bit more license. I wouldn't necessarily say we actively manage currency, we actively trade currency, but it gives us a little bit more license to kind of unhedge various parts of the portfolio, because obviously the risk that comes with that can be palleted by, say, for example, a P7, which can't be obviously done in a P3 or a P2. So I think that's worth.
And yeah, look, and the other point is, if you take the starting rule of thumb, in your higher risk portfolios, you have more equity exposure. In your low risk portfolios, you have typically more fixed income, and so the hedging is a bit more pronounced.
Also, yeah, exactly that. Another one that's come through related to, and this might be a more difficult one for you to answer, but you know, we do it for the clients. The Bank of England will either obviously have to do an urgent rate hike or wait until November. What do you think is best?
Yeah, so we've been having this debate, as you might imagine, over the last day or so, and it's not straightforward, inevitably, right? And so it's not straightforward for a couple of reasons. One, you know, in general terms, you know, investors seem to like their monetary policy to be predictable, right? They you know, the market prices in some sort of an expected outcome, and broadly speaking, by the time it gets to the decision, you know, the range of outcomes has shrunk, and in this case, it's less clear, and that makes us all a bit more uncomfortable. So I think that you know, I think our preference, we don't usually, I should say, usually we don't have the luxury of having an opinion of what should happen. We spend most of our time thinking about what will happen. So what we think will happen is that the Bank of England, will delay a rate hike as long as it can, and will use other. I think the chief economist came out and said as much. So I'm not sure that I'm coming up with anything particularly insightful here. But the range of outcomes, the Bank of England will hold on as long as it can from making a rate hike, because it sort of said we're going to make a decision in November, and it would rather not do it ahead of time. The other thing that we need to think about is the scenario, which is, what if the Bank of England hikes rates and that doesn't do anything to stabilize UK financial markets? And you know, and that's then you have a real credibility problem. If you think back to one of the Euro crises where Draghi stood up and said, "We'll do whatever it takes to defend the euro," and then didn't actually have to do very much because markets believed him. If the central bank hikes rates in expectation that this will stabilize financial markets, and then for whatever reason it fails to do that, then you know, what do they do next? And so that's a scenario that we would rather not see. And so we think that they will continue to hike rates as they were going to do anyway. Maybe they will find themselves forced to hike sooner than November. But our starting assumption today is that they will do their best to hold on until then, if they possibly can.
Makes sense. Thank you. Another good one here, actually, something we don't necessarily discuss or that much with clients directly one-on-one, but it's a very good question here. So do we see any major risk? So obviously last time there was a kind of major recession, there was a lot of talk about defaults, countries defaulting on their debts. Is there a risk that this sort of thing will happen again? Or is inflation enough to help governments to pay back lower values at the end of the borrowing period?
So I think, you know, the key point about for sovereigns, at least, the key point is whether you control the currency or not, in a very kind of theoretical sense, right? So you could say reasonably that the UK is not going to default because I mean, fine, you could say that they have an independent central bank, but the UK is not involved because somewhere along the line, somebody can print in the UK can print money and pay off the debt, and at a very high cost, in terms of the economic impact, but they can do it. The argument with regard to the Eurozone was always, well, it's not quite that simple in the case of the Eurozone. So, and you see this meaningful spread at times of stress between some countries and other countries, right? And so there's that dimension. Similarly, in emerging markets, in the past, and you've seen a number of defaults over the years. In emerging markets, if you're borrowing in dollars, obviously you need to earn those dollars somehow to pay them back. You can't print them yourself, and so generally those are the sovereigns that borrow in dollars. And so there's potential for greater stress, and we had considered that when we thought about our sizing of our emerging market debt positions, and also the duration. And the last point I would say is also the country composition. You look at the country composition quite carefully in that context. So it does depend. We don't think we'll see significant sovereign defaults. We think you might see some within the full emerging market universe, but probably not in the countries to which we have any meaningful exposure to. And our emerging market debt exposure is I would say relatively small today. So but in a period of economic stress, this is the sort of considerations that quite rightly we should think about, both on the sovereign side and also then obviously on the corporate side. When you think about corporate exposure, particularly high yield exposure, how much do you want to have? What do you think is implied in the price in terms of the likely default rates? These are some of the things that we consider when we evaluate the kind of attractiveness of the opportunity.
Yeah, that makes sense. Makes a lot of sense. Brilliant. You touched on emerging markets actually, and obviously they've not done particularly well recently. It's just the question: do you anticipate this to change over the next 1 to 2 decades, with them overtaking returns from more developed markets? That's obviously the traditional view. The kind of the catch-up theory, the rate of growth. These markets will in a longer term outperform. What's your view on this? And obviously, in light of the recent struggles they've had, does that change anything?
So look, I would say, let's deal with our starting position. Right? Our starting position is we have exposure, particularly in the high risk portfolios, we have exposure to emerging market equities. In the context of a global equity universe, it's not a kind of a very aggressive position. It's around neutral, and we struggle with precisely what kind of the scenario that the question describes, which is that valuations look decent versus history. Earnings expectations have come down maybe more than they have in developed markets, and maybe that creates an opportunity. Maybe we'll see a recovery in some parts of emerging markets faster. But generally, what we've seen is the stronger growth that you have seen in emerging markets has not always been associated with stronger profit growth. And you can debate the reasons why, but it's very much it's in a lot of cases part of this question around how do you relate GDP growth to earnings growth and then to equity returns, and that's a kind of a challenging question. But one of the challenges in the past has been that stronger economic growth that you've seen hasn't necessarily translated into better profit growth or higher returns for equity investors. So where does that get us? We think that valuations look reasonable. We've generally been disappointed over the last couple of years, at least, by earnings, and we continue to think that emerging markets will become increasingly relevant within the global economy, and so we need to, we think it's appropriate to have exposure there. But what you really need to see is an indication that corporate profitability is really improving. Some of that is around governance, some of it is around the cost of capital and how growth is financed. And obviously some of it is around policy and politics and geopolitics, and these are all things that we need to consider. So I think we've wanted to own more emerging market equities than we probably do today, but we've generally been held back by concerns about the return profile. And what we think today is that you've seen a meaningful downgrade already in those earnings, and that potentially emerging markets are in a slightly better place to recover. Given also in a lot of instances lower rates of inflation than developed markets. So we have that exposure, but we haven't been very aggressive about increasing it.
I think it also depends very much on the nature of the fund you're using for emerging markets, right? I think a lot of ETFs, particularly if you're investing in emerging market ETF, you have a large weighting towards China. And obviously all the stuff that comes with that, there's a lot of difficulty with investing in China. So I think what we do tend to look at, and correct me if I'm wrong, is ultimately we do assess obviously the situation within China, the debts, etc. Obviously the situation of government and the freedom of their markets. But a lot of the growth tends to be driven by them, particularly on the weighting basis. Is that correct?
So China is a meaningful part of emerging market equities, and so you do need to end up taking a view on China, and as is the case in developed markets as well. You've seen a meaningful shift in emerging markets generally from what was once quite a commodity heavy universe to actually one that's very tech heavy. And you think about some of the very large tech companies in Korea or Taiwan. You think about some of the very large tech companies in China, and so you have a very different set of exposures to the ones that you might have had 20 years ago. And look, policy is in all of these markets, policy can be a meaningful driver. Frankly, as it can be the case in developed markets, but policy clearly a meaningful driver, and you've seen that in China, particularly in the tech space over the last couple of years, and you've seen a derating on to some extent as a result of that. So yes, you absolutely need to be prepared to take a view as to what sort of policy risks are you running in China or elsewhere when you think about the emerging market exposure that we have. Fantastic.
It wouldn't be an investment event with a question like this. It just popped through. One of your favorites, Richard, but I think it's worth addressing always. And I think obviously in light of on various asset classes that you touched on at the start, being less more correlated, and obviously diversification effects being limited, what effect would or could crypto have? We do get less of these questions.
Yeah, no,
since June, but we do get them. But I think it's a very relevant question.
No, I mean, it would be. We shouldn't. Let's be clear. We, as you can imagine, spend at least some of our time discussing crypto. We have, it's in the past, it's been less of an asset class that we could actually really invest in, given our structure. But it's likely to continue over time. And so the question for us is, that's a sort of philosophical question of what is crypto and who's it appropriate for, and what are the come back, you talk about regulatory risks in emerging markets. You could apply regulatory risks in crypto just as relevant. And then the other question is how is crypto's interesting in this sense as well, right? You talked about diversification, and to what extent is crypto actually becoming less of a diversifier and more highly correlated with the Nasdaq, for instance, right? And so we haven't run the analysis in a couple of months, but what I think you may well find is that the correlation of crypto to tech stocks has risen and become more of a leveraged play on tech stocks for whatever reason, and then it may be as simple as that more and more institutions are becoming to be active in terms of their trading of crypto, and so they are applying statistical analysis or analysis that worked in the FX market, for instance, or in other more established financial markets, and applying that to crypto. And so when we do come to look at crypto more closely, we may find that it's more of a leveraged tech bet than it might have been five or 10 years ago. But that's that's something to consider. We continue to think about ways in which we can provide crypto exposure to those clients for whom it is appropriate. Let's put it that way. And you know, let's see what we come up with. But you know, as you know, we're generally fairly conservative in terms of taking on new instruments like that, and so probably not immediately keen to find ways to put it in standard portfolios right at the moment.
Yeah, I think it's worth bearing in mind. Actually, it's a good opportunity to mention. I will hesitate to give a time frame, but there's something we are considering very heavily within Moneyfarm and hoping to release at some point, probably at the start of next year. But obviously, this is fluid. We are looking to add more thematic options to portfolios, and I think one of the options will maybe be crypto, but it'll be the sort of area where clients can necessarily add a slight bit of jazz to their portfolio, should we say, you know, as I don't know, biodiversity stocks or something like this. And I imagine crypto might be something that we consider in this element as well. So if we have people who have something where they want to manage have a portfolio managed, but they want to have a slight tilt towards crypto, this is something that we might look to offer in the future. So if this is something relevant for you, keep your eye out, because we will probably announce something hopefully towards the end of the year, but obviously these things are fluid. We'll have a couple more questions and then we'll call it a day. If we haven't answered your question, we will obviously follow up. One of our consultants will reach out to you and engage, send you an email and kind of answer your questions. And again, obviously, if there's anything that you want to discuss, please obviously book an appointment with us as well, and a consultant can have a conversation one-on-one. But just going around to the last couple of questions. One is around ESG, and we've not really touched on it so far today. There's been a bit of a divergence in the performance of ESG portfolios versus the classic this year. What are your thoughts on that? What are your kind of, you know, let's say thoughts going forward, and obviously thoughts on what's happened so far this year?
So I mean, there are a couple of thoughts when you think about ESG, and you take a step back and say, well, when we constructed ESG portfolios, we wanted them to look different from, or have different exposures to the classic portfolios. You know, sometimes you see investment options where it's sort of a bit ESG light, and it looks more or less like there are some negative screens, but that's about it. And we generally took the view that we thought the customers would want something that did look quite different in terms of the exposure, and so we went for a sort of greener version, put it that way, in terms of the level of screening that was done on these ETFs. And what that meant was that there was rather less energy, and perhaps a bit more of a growth bias to some of the particularly some of the equity exposure. And as we've seen, you know, the energy sector, particularly in the US, has been a significant driver of returns. And that was something that, to a large extent, our ESG portfolios didn't benefit from, perhaps as you might expect. And if you looked at the S&P 500 energy versus the S&P 500X energy, you would see over the course of the year a very, very sharp divergence in terms of performance, and that would kind of capture the distinction between ESG and the classic portfolios. And obviously, I mean, to the extent that it would have helped, you know, the ESG portfolios also don't, as you might imagine, have any commodity exposure. But really, if you think about the composition of equity and the screening that would happen, that the energy versus X-energy split is probably the most relevant metric.
That makes sense. I think it's worth bearing in mind as well that E, S, and G are three very different things, and obviously it's, you know, as this sector is, well, I say, you know, developing, it's been around for a long time, but really gathering some speed. You do see a lot of people say, okay, bracketing them together is obviously perhaps maybe something that might not happen in the future, but it's very important to know that we very much focused on the E side of things, right? Then we had some elements of the S and the G, but obviously when you kind of focus on the environmental part of it, and obviously kind of carbon emissions, etc., were a big factor of our screening process. Comparing that to people who maybe were focusing on board diversity or something like that, obviously you tend to find, you know, this is an area where ESG comparisons can sometimes be difficult, because kind of apples to apples is a very different metric, because you have many more variables to tussle with, right? I think that's fair.
I think that's fair. I think that when we think about evaluating, and we spend a good amount of time of looking at ourselves relative to kind of alternative options in the market, when you analyze a kind of a classic portfolio, you analyze it purely in terms of risk and return. When you analyze an ESG portfolio, you look at it in terms of risk and return, but then you also overlay that with a measure of some ESG metrics to see, well, okay, how ESG is this peer, and is it an appropriate kind of comparator? And so you do see that there is a difference between peers who had relatively a higher commodity exposure, however you want to define it, and those who had less. Those are there is a challenge in evaluating ESG peers, both for us and for customers, and so as you say, we made a choice as to where we were going to emphasize it, and you can see that in terms of the portfolio data relative to our classic portfolios that is on the website. An environment where, as I say, where energy has done relatively well, that probably hasn't helped.
Brilliant. Last question. I think it's quite a nice one to kind of finalize everything through. It's quite broad, so I'll let you kind of do with it what you will. But what's Moneyfarm's outlook for the future, whether that be for the rest of the year, for the next couple of years, for the next 5? What's our view? And maybe in light of obviously our recent rebalance, kind of says something itself. But what's our thoughts there?
Sure. So let's use try and use the positioning as a starting point, right? Never mind what I say. Let's what do we do? Yeah. And so we, relative to some of our internal metrics, we would say that we are still underweight equities. So we have less equities than we might normally do. We have less long-dated government bonds than we might normally do. We have probably a bit of a bias towards the US relative to Europe. We have a bias towards UK equities, large cap equities, not small cap equities, on valuation grounds. And so what does that tell you? It tells you that we are, in our minds at least, still a bit conservatively positioned, but not so conservatively positioned that if markets rally, we will completely miss out. And that probably feels like a fair assessment of our thinking, which is that we think that some of this is priced in. We think that there is likely to be some challenges over the next few quarters, but that in the end we will that there will the supply and demand issues will, broadly speaking, be brought back into balance. That inflation will come down, and then you will have the opportunity for hopefully another cycle to begin. And so the challenge there is, well, when's it going to happen? And that this is the issue the point that you made about trying to time it, and trying to time it is somewhere between challenging and futile. And so we express our views, we express our tilt in the sort of conservative direction, but always mindful that at some point we think that it will, a challenging economic outlook will be fully priced in, that we believe that inflation will begin to come down at different speeds in different places, and that then you will potentially see you'll be at a rebased level of yields, a rebased level of profitability, and the opportunity then is there to see a recovery in growth from there, from what we've seen over the last year or so. So, as I would say, still conservative, still quite constructive in terms of what we see over a longer term perspective, but clearly we have to acknowledge that there's a period of economic weakness that we're currently living through that will be with us for a little while. Yeah.
Brilliant. That's very, very good. Thank you, Richard. So that's all we have time for. So thank you guys for joining us for the first Moneyfarm Open. As I say, we'll be looking to do a series of events, so please obviously join us next time. We hope you enjoyed it. And there will be a short feedback session after this closes. It will literally take 2 minutes. We'll be very grateful for any and all feedback you can give us, just because it will ultimately help us to make this experience better for you. But I once again like to thank Richard for his time. Thank you. Thank you guys for your questions and for joining us, and I wish you all a fantastic evening.
Have a good evening.